So the positioning had already been stretched, as I said weeks earlier. Gold and silver
Mhm.
become moving vertical, that kind of upside, a market becomes fragile. I mean, the leverage rises and liquidity thins. You throw a ball into the air, when it starts off, you give it a lot of force, it's fast, it slows down, it stops. Momentum stops, it stops momentarily, and then it starts down. That's a good analogy. It only has so much buying power, even from these massive banks. The banks are net short the last time I looked. So they're waiting for some kind of sell-off. So I don't want to make the AGQ the exact trigger, but it certainly played a part because it's double leveraged. So you're leverage upon leverage. So you get the
Mhm.
point. And because it was stretched, we were just due. So now what happens? A mechanical accelerant happens because margins had been margin hikes were going to occur after the close, and this forced liquidation. So people that were putting up, the normal 8%. So look, at $50, $100 silver and $5,000 gold, it takes 44,000 in margin to hold one contract in gold, but 75,000 to hold the same amount in silver. Both those contracts are worth 500,000. So again, at 5,000 gold, 100 silver, they're the same paper value exactly, 500,000 per contract. But one takes 44,000 to hold a position and one takes 75,000 to hold a position. You can see where I'm going with this, Michelle. Most of these people that trade futures, even the funds, are over leveraged and undercapitalized. And so it doesn't take much to kick the can the different direction than what they're betting to get this kind of a fall off. Well, first of all, I think what it does reemphasize, first and foremost, it matters the most to the public because the public will learn again to distrust paper claims on gold and silver, even inside China. And I know we could, if we have time, talk about what's going on there with some shenanigans with not being able to deliver. We'll address that later. But that's number one. If you don't own it, you don't touch it, don't hold it, you don't own it. So I think that's been reemphasized. The second thing is none of the fundamentals change as you outlined so eloquently. Lastly, it's an opportunity for people that are late to the party. I mean, there's people that watch silver go from the $50 breakout all the way to like 120, not, last week, and saying, oh, I missed it. Now they're seeing it below 80. It's off, 5.5% right now. As I look at the last one I have on the chart here, and it's $80. So 80 to 140, that's a big percentage move just to get back to where it was, a few days ago. And I think it will do that. I don't think this is over by a long shot. In fact, I'd almost say I know, but I don't want to get in trouble with the authorities. But all indications are nothing's changed other than over leverage. That's been wiped out in a day. It'll probably take a couple more days, Michelle. Usually these type of what I call waterfall declines take about 3 days at a minimum just to clear the books. I mean, there's people that say, yeah, I'll wire the money, I'll cover my margin, and guess what? It doesn't come in time. Then what happens? Well, they sell them out. So there's a lot going on kind of behind the scenes that needs a few more days in order to clear the market. Once that takes place, we'll get a better feel for have we hit a bottom and we're going to bounce back up, or we're going to have to build a new base along the $80 level for silver and $4,500, $700 range for gold. We don't know yet. Q2, I think we're so strong that at the end of Q2, we'll see triple-digit silver again. I'll leave it there because that leaves it real safe. It could be 101 or it could be 201.
According to David Morgan, over-leveraged funds, particularly the AGQ2X ETF, dumped $4 billion in futures, causing the crash. He expects triple-digit silver by Q2 and $6,000 gold this year. The fundamentals haven't changed. He says this correction is healthy, and if you don't hold it, you don't own it. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
It's the anchor of the whole restabilizing this casino that we've had in the financial markets for the last decade. And so more and more people will run the gold, banks included, as we both know. So I just think it's a blip in the road. I mean, it's a big blip. Sometimes you get, those barriers. You got to wait until they move the barriers or the bridge has to be rebuilt or whatever. I don't think it's a bridge needing to be rebuilt. I think it's a barrier in the road. that the crew's coming to take it down, and you're going to proceed down the road further, and we're going to see higher prices probably in the next quarter or so, and that we're probably going to see that $6,000 mark this year, if not higher. Silver, I do see triple digits, and I may be slow down for a while, but I think there'll be a reacceleration, and that may be the last one. I don't know at this time. I don't have enough information. But we are going to get to a point where that whole new system needs to be built. And as you and Andy have done for quite some time, talking about this alternative with the Silk Road and the brick system and other pushbacks that are out there relative to what the current system demands. And I think the best outline of what really took place is on X, and it's Solix Trading, SOLIX Trading. And I just reposted it on my X feed. So it's a repost. What happened Friday is the edit I made to it. And it's, I'm at Silver Guru 22 on X. So if you want to read all the details, go there. But briefly outlining it, Michelle, the AGQ is a 2x leveraged silver ETF, and it aims to deliver twice the daily performance of the silver price using futures and other derivatives. So what happened when the silver prices started to plunge, the AGQ being leveraged didn't move by half. It dropped by about 60% in a single session. So from that aspect, you could say it was more than Silver Thursday, but I don't want to, go into the minutia yet. Because the fund's mandate is to maintain a 2x exposure each day, it was forced to sell futures to rebalance the fund. And of course, selling begets selling. So say that AGQ had $5 billion in assets. That means $10 billion in silver exposed at the start of the day. A 20% drop would reduce their value to about $3 billion. Think about that, 10 to 3 in a day. To reset the exposure back to 2x, the fund must cut exposure from 10 billion to 6 billion, meaning roughly 4 billion of future sales dumped into the market around the worst drop, or almost the worst drop in history. So I think I'll stop there and let you catch up or give me some feedback.
Wait, so you're saying that this was predominantly triggered by one major fund?
I think so. I mean, I rightfully have the respect of the audience to dig deeper, but looking at it as deep as I've been able to do in the last couple hours, I would say over leverage is key. So that is the broad-based generalized statement that's accurate. But then if you want to go further into, okay, so what, which one, I would say this AGQ, and I think there's another one, I forget the symbol on it, that are these 2x funds that are massively leveraged and have a lot of capital. And not so much anymore. To the details I gave you about silver with the AGQ, but over leveraged, it's normal activity. When you go straight up like that, you lose momentum. And then the people that are on the other side, which is usually the bullion banks, the commercials, see an opportunity and they sell into it to increase the momentum. Margin requirements go up the next day and away you go. And so it's kind of a shortened version of what I said about silver, but it does take place. And really, in a way, and people may get upset with me emotionally, but I think in the longer term, they won't. It's actually healthy to get a correction here. And remember, the function of a major bull market that we're in is to shake off as many people as possible all the way up. I mean, there aren't too many bull riders that go the full 8 seconds. And, that's a metaphor for holding on to that bull to the very end. And there'll be a lot of people that got in at $50 silver, and maybe they got out at 100 and they were on leverage, and they'll never touch silver again because they wanted the paper profit and they know how volatile this market is, and they accomplished something in a matter of weeks that silver holders that have held for 25 years haven't accomplished. So as far as, profit or paper profit. So it's a very interesting market. I won't belabor it any further, Michelle. It's normal. It's okay. It's okay with me. And the longer term, it's healthier because it allows the market to shake out what we call weak hands. The strong holders are still holding, and now new people that are willing to, let's say, mitigate the risk in the overall financial system are able to come into this market.
What is your outlook on gold then?
Physical gold remains tight. It's quietly the same place it was without all this futures movement. The Asian demand didn't vanish. Premiums compressed a bit, but they didn't invert. There was no flood of distressed physical supply sales. You did see that somewhat in the silver market. The market talked panic, but it really didn't realize it. The market confirmed it's strong. This is where watching the flows probably are more important. As I said, central banks were selling. And I think the key here, we haven't discussed, but critical to gold, silver, but gold particularly is gold versus the dollar. This is a key. And the dollar bounced hard and gold corrected. That's normal. What matters next is if the dollar holds firm and gold stabilizes. That's a bullish divergence. And we may see, as I said earlier, that we'll get a new back and fill, as it said in the commodity parlance, of where we get some kind of a trading range for both gold and silver. And that, again, would be healthy. It would actually stall out people that expect this rocket ship move to start a day after tomorrow, and it doesn't. It starts to level off in the trading range. And they get bored. Silver's gone from, I don't know, make up two numbers, from 75 to 85 for 3 months. Oh, it's not doing anything. No, I'm getting out. And then, of course, the market starts off again. But I think it's going to come up rather quickly because we are in the final phase of a currency destruction.
Mm-hmm.
And because of that, there's more and more impetus by people that don't even know how to spell gold right now, thinking about it and taking action upon it in 2 or 3 months from now as an idea. One of my subscribers, you could imagine what my life was like on Friday. And he went through what happened. And, I think I gave him like a 6-point post back to his email. And I talked about Worsh as the first thing, because that's what you're getting from the mainstream. But I said, that is really, in my view, a way to perpetuate the idea that's very important, that the Fed is all powerful. I'm going to digress for a moment. I'll come right back, Michelle. But in the movie Four Horsemen, which I'm in, is Julia Tank, who works and still does, to my knowledge, at the Financial Times. So something very interesting in that movie. And we're talking about the markets, gold and silver particularly, and what was the important point of all of it. And she said the cognitive map was what's important. A fancy way of saying it's what you're taught to believe about these markets is what gives these banks the ability to have the control that they have. So I digress, I'll come back, but gold behaved exactly as it should have in a stress event. Gold corrected sharply, but it did not structurally break. Silver collapsed, but gold absorbed the stress. Gold is sold off, it's highly liquid, highly traded via futures and ETFs, and routinely becomes a source of cash when margins rise elsewhere. So that's what I'll call normal activity on a very stressful day. This was a leveraged flush, not a repudiation of gold. Gold's drop was driven by forced selling from futures, as we said, margin hikes, and fund selling what they could if they needed money for margin calls and other areas. There's no evidence of central banks selling. I think that's important. What we know for a fact, Michelle, is that the exchange has to protect themselves. I mean, they do have a dog in the fight. They are responsible. So in order to mitigate any, let's say, counterparty risk, which is tons, but to mitigate the risk, to lower the risk, they have to do what they have to do. And of course, they set that basis. I don't know if they have a math formula or not, but they basically say, look, it's really wild. We have got to mitigate this, and therefore they raise the requirements. Again, I just go back to what I said a moment ago. Gold is much more stable. 10% is a big move in any market, but silver was 3x the gold move in percentage terms. And therefore the margin was significantly higher, almost double, not quite, but almost double the margin needed for a gold contract in those turbulent times, saying that silver is more turbulent, therefore more margin. I don't think it was unfair. I mean, people that trade futures, they sign a contract. If they don't read it, that's their problem. I mean, I traded futures for years. I do it very sparingly these days, but nonetheless, you can't complain about the game if you sign a document saying you know what the game